Mr. Chandrasekhar K joins us now, CFO with BHL. Mr. Chandrasekhar, good morning. Thank you for joining us. Hope everything is fine and safe with you, your family and your employees. Right. So my question, Mr. Chandrasekhar, is that let's divide the world into two parts, pre-COVID and post-COVID. Now that lockdown has got lifted, how much normalization has happened to your demand and where exactly your current demand levels are if you have to compare them with the pre-COVID period?
Thanks. Everyone is safe and also at Jockey and Page Industries are doing well. They have resumed business. I hope all of you are safe, healthy as well. It is still early to say, whether pre-COVID, we are only a month in terms of sales operation. The sales trend has been quite encouraging. At the same time, it is too early to take a call on the demand. But in terms of numbers, if you look at nearly 75% of our retail outlets, we have close to 66,000 multi-brand outlets retail, which have already resumed. So barring the containment and the red zones, we are supplying to most of them. If you look at the exclusive business outlets, almost 90% or almost 680 outlets have opened. Large stores, have opened close to about 65 to 70%. That's about 1,300 stores. So we are on a good trajectory. And I would say that post lifting of the lockdown, we have exceeded our own expectations as to how things will pan out, because April and half of May, of course, was a complete shutdown.
But if I specifically focus on your Q4 numbers, margins have dipped, sales have dipped. Now, even though the lockdown was there in Q4, the lockdown only got at play in March end, which means for Jan and for Feb and for better part of March, your normal business. So your Q4 numbers are also indicating that the normal business also in the pre-COVID business was rather slow.
First half of the quarter has been captured. But what has happened is that even prior to the lockdown, there were some of the geographies were disrupted. So the official lockdown came on 23rd March. So we were heading, if you look at the YTD December 19 numbers, we had grown revenues by about 7.5%. And in Q4, we were hopeful of reaching towards about closer to double-digit growth for the year. But eventually we ended up about 3% growth. So Q4 has had an impact due to two reasons. One, we had a lot of orders on hand and we could not bill and dispatch because of the closure of the warehouses. And secondly, we also have invoiced and not dispatched, invoiced and not delivered, because as per the Ind AS 115 accounting standards, only what is delivered counts as sales. So nearly about 90 crores of business have not been delivered and so are not in the Q4 numbers. But the impact of the revenue loss would be more than that.
Fair point, but if I look at the CAGR growth, just for the benefit of our viewers, the cumulative growth for Page Industries, here's how the data looks like. It will just come up on your screen. Your 10-year CAGR is about 28%. Last 3 years it has come down to 16%, which clearly means that either the base effect has kicked in or the category which you represent is slowing down.
Over the past 2 years and about 6 quarters, the growth has not been in the 20% range, but we had been growing somewhere in the early teens. The double-digit growth was always happening as far as the revenues are concerned. The way we approach the business is we are in it for the long term. There will always be, this COVID situation is something which is extraordinary, and we have sort of accepted that and we are bouncing back. But eventually the market is much larger than what Page alone or any of the premium players supply. So there is no reason, in fact, while the innerwear and the knitwear market is estimated to grow at about 10% CAGR, the premium market, because of the people, upwardly mobile middle class and the demand for quality products, is growing at the rate of about 15%, barring this kind of lull which we have now. But eventually we should see very strong growth numbers in the long term. We have a top line aspiration of $1 billion in about 5 years. So we are heading towards that. In fact, we are doubling the manufacturing capacity from 260 million in the next 4 5 years. Some of the capex has been sort of put on the back burner in FY21 because we want to preserve cash flow. And then as we observe the sales trends in Q2 and Q3, then I think surely the investment will return.
So can I safely assume that if not in this quarter, but by end of next quarter or by first quarter next calendar year, mid-teens, 15 to 18% growth for Page Industries should be back?
It definitely is. That is the way we prepare and invest. We have invested a lot in sales management team. We have created a separate kids vertical with about 140 people on board. They only focus on the jockey junior vertical, and we see a tremendous opportunity both in offline and in online sales, even in the current situation. And some of the competitors have had their distribution channels disrupted, but we were among the first to get back into the market, and we have close to about 85% of labor has reported back to our manufacturing units. As I was telling you, a large part of the distribution and the retail channels have opened, and we actually are pleasantly surprised with the kind of demand that is there post the lockdown was lifted.
The pitch on which shareholders have invested, or the pitch for which investors have invested in your company, is that you represent the premium innerwear category, highly underpenetrated. Organized market is not even 10%. So what are the trends you see because of crisis there? Because one would argue that that is one category where some would imagine that there could be a late recovery. How much of the unorganized versus organized market picture do you think will now change post the crisis?
Q4 is an exception, and I think even in some of the earlier conversations, I had highlighted that in FY20 we were really going and investing in the future, and that is why we expanded the sales team. We created separate verticals. We've invested a lot of in the technology, and we are implementing JDA, and we were about to go in for S4 HANA, and those kind of investments are not going to pay you in the same year. But we are well aware that we have the kind of balance sheet strength, and we have such optimism on the future of the industry and Page itself in particular, and that is the reason we invested, because the idea was to get double or move into the 1 billion revenue as soon as possible. So the margins used to be, EBITDA margins used to be around 20-21%. So eventually when when the top line grows, all these costs will get absorbed. Nevertheless, FY21 is not going to be like any other year. So we have pretty robust control and a handle on the operating costs, and we are keeping the fixed costs down, and we would plan to have opex not more than what we spent in FY20.
Now, Page Industries or Jockey has dominated the market, and you had a first mover advantage there. But that's one space where a lot of organized and established brand apparel companies have also moved in, whether it is Van Heusen or Arvind. So do you think that with the entry of 3 or 4 large, big store retailers, there could be competition, and premium and pricing both would be under pressure?
Consumers need to have choice, and in the premium space as well. And the Indian market is so large that overall our penetration in the premium segment is only about 11 or 12%. So there is definitely room for more. And in terms of the nearest competition, we are maybe 10 times that kind of volumes we are doing pan India with the kind of distribution network. We have been around for 25 years now. So there have always been competition and players in the market, and we remain, uh, you know, an affordable premium where proposition to all our consumers, and that is the reason we have been growing much faster than many of the others. And also at the same time, we need to have we need to have a viable business model which is profitable, and we are debt free. We have a return on capital employed of close to 55% even in this year, and we have a lot of strength in being able to invest.
Walk us through the cash flow picture. You run a business which has distributors and franchises. Cash flow has been a problem. How exactly is your equation on the cash flow working? Are you facing a crunch there, or are you also going out of your way in order to help your dealers and your franchise currently who are suffering because of cash flow issues?
We have done very well, and in fact, I would say we have exceeded expectations because the cash flow position with zero collection in April and almost negligible in March, I mean May, it looked a matter of concern. But then, since the lockdown has been lifted, we have bounced back significantly, and we have collected more than about 230 crores. And in fact, the demand has surprised us, and we are gearing actually to improve our back end also. So we do not offer any additional schemes or incentives. We don't offer extra credit to the distributors. So we operate on a fairly fully secure model with the distributors. But then we did give them a sort of extended moratorium between the 23rd March lockdown and for about a month or so. And subsequently, with the undelivered sales reaching them, distributors have started paying. And we are in a fairly comfortable position as far as cash flow is concerned. We have not borrowed any funds during this period itself.
The concern, Mr. Chandrasekhar, for Page is that whereas you've been a success story in the men innerwear garments, you've not managed to replicate that in other categories: women innerwear, loungewear, and even children's category, or kids.
It is an evolution of the brand as we see it. We started and we were known as a men's innerwear brand, and which we still continue to dominate. Women's innerwear also, we are the largest player in the country in terms of volume. If you take socks, we are the largest seller of socks in India. Athleisure is growing rapidly, and Athleisure has been the new engine of for growth of Page in the last 5 to 6 years. So there is a stage in the evolution of every category, and we also have come out pretty strongly in as far as kids market is concerned. So there are plenty of products on offer in the Jockey Junior category.
Having said that, I would say 2 years have been challenging for consumer categories, including Page. Now that business has decisively slowed down, and there are going to be the recovery is going to be a long road ahead. Would you be looking at cutting your capital expenditure, looking at conserving your cash? Where are you looking at cutting the rough edges?
We are very bullish on the medium term and long term because of the potential of the underpenetrated market in India, where branded players and premium players will have to definitely reach out. Though we are present in so many cities in India, still we are not. We are only present to the extent of about 20% of where we can be. So there are tier 3, tier 4 cities, and even within the same catchment area of a metro, we are opening new EBOs, new distributors are joining us. So we have a continuous expansion of the channel. So we have, when this is the situation of an underpenetrated market, then as a market leader, we continue to invest both in the in terms of the manufacturing capacity, as well as at the in the technology that we have, and also in the marketplace. So we'll continue to invest. And as I told you, we have plans to double the manufacturing capacity in the next 5 years. So that plan remains stable.
So apart from the short-term challenge, which is for a quarter or two, that's what you're telling us. What are the other red flags which potentially could have an impact on your guidance or on your proposed recovery?
There are no red flags because we fall under some of our products fall into the essential space for premium. So definitely the demand has proven in Q1 that there continues to be a demand. Now there are no red flags as far as Page is concerned because with the balance sheet strength and being debt free and also our cash flow being positive, we are in a position to invest. Some of these investments may have to be deferred to protect the cash flow. It depends upon how the Q2 and Q3 kind of revenues pan out, and then we'll have to be careful on the opex and the fixed cost in the short term. So the next couple of quarters will give a more clearer indication as to what kind of investments we can further make.
All right, Mr. Chandrasekhar, appreciate your time. So glad you could join us, and thank you for being very descriptive. You, as a policy, I know Page Industries is quite reluctant to talk to media, but I'm glad that we got into this engaging conversation where we've really covered all corners on demand, expansion, premiumization of the category, and also how are you essentially looking at protecting your cash flow. Stay safe, sir, and thank you for joining us.